Well, that's the market breadth. Now, whether or not we see some weekend cheer coming in for the street is what we should all be, or rather are hoping for. But Manish Sonthalia, Chief Investment Officer at MK Investment, joins in with his view and perspective on the markets. Manish, good morning. Thank you very much for joining us. The last few days pretty much came out of nowhere. I mean, yesterday in particular, so the markets declined quite sharply. I know historically we've seen FIs who rather wait, buy at a premium after there's a conclusive event outcome as opposed to actually come in ahead of that. But as you see it right now, where do you think the biases sit? Do you feel like there could be some more buying coming in on the street, or it's going to be a little bit of a pause before some bit of gains return?
So I think the recent events over the last few days has been to do with liquidation of some hedge funds, India dedicated funds, which had to close down. And I think there was forced selling on account of liquidation of the assets that they had in the fund. I don't read too much into the fall apart from this. In addition, you have the regular volatility that comes along with any sort of elections. As the election passes through the phases, you start with high optimism, then it wanes in the middle, and then the likely scenario and the results starts to play out towards the end of the election. I think in India also, started with 400 seats for the BJP government, now NDA government, and then now fourth phase. You hear on the streets that even 272 is not coming, and then I would reckon that as you approach the seventh phase, you could settle somewhere between 330, 40, which gives you a majority on the government, policy continuity. You have a whole lot of money sitting on the sidelines waiting to get deployed in India, even if it means a 10% higher from the current levels. So, I wouldn't believe that there's any reason to be simply bearish on India, because the season has played out, numbers have been okay, and I think sentiments also are quite reasonable.
Manish, I guess it's not just elections, right? So while you have elections on one hand, you've got earnings that have not done very much to enthuse the street. You've got the Fed that's got a delayed rate cut from the look of it. You have China that's making a little bit of a comeback. You have higher commodity prices, anticipation at least, which will eventually impact the input costs for a whole bunch of India. But let's not forget that investors have made money. At this juncture, what is the advice that you're giving out? Are you advising investors to sit on some dry powder, take some profits off the table, stay off adding additional money into the markets? What is the strategy? What should the strategy be? What percentage of the portfolio should be on cash?
I would believe that since we are towards the fag end of the elections, and in any case, medium-term outlook on India is quite positive. On the back of high teens earnings growth on the benchmark Nifty for the next 1-2 years at least, you have valuations which are not very expensive. Earnings season for Q4 began with a preview of around 5 to 6% YOY growth. If you leave aside the metals and the oil and gas pack, earnings are in line with around 15% sort of a growth, which is quite decent, I would believe. Yes, there is fear of some input inflation coming through, but that's going to work in favor of producers of commodities also. Pricing power is going to be important in that regard when it comes to users of the commodities. And as far as the Fed cut is concerned, yes, the cut didn't come about in March. Then in the middle, you believe that there's not going to be any rate cut in this calendar year. And now the base case opinion is, no, there is going to be a rate cut this year, calendar year, and that rates in the US are not going to rise. All of this means that, as soon as the bout of cutting of rates for the Fed starts, emerging market as a whole starts to benefit. Of course, emerging market has seen outflows except for maybe a Turkey and a China. They are seeing inflows, but there has been profit booking across the board. Emerging market flows have been negative. And India has also seen a bit of FII selling. But that has nothing to do too much with fundamentals. I would believe valuations are quite reasonable. if one is not too overtly worried about the next 5% correction on the downside, I think it is a buy only.
So, sorry, it's a buy on dip. So fair, so you should not be fully invested, Manish, at this stage. I'm a little confused. If it's a buy on dip, then I wait it out, right? I'd imagine, or stay fully invested.
Yeah, I mean, who worries about a 5% lower downtake on prices if you are positioned your portfolio for the next 2 to 3 years? I mean, it hardly makes a difference. So from that point of view, I'm fully deployed. And in any case, we are asking investors that if they can top up the current correction in the market, and there's not been too much of a correction, so to speak. You had 22,600, 700 on the upside on the Nifty, and currently maybe you are at 22,000. So a 3.5% correction doesn't mean too much, but there is a lot of fear in the markets that the markets may have fallen a bit too much. But I would think that market positions are extremely light. There is apprehension on the results, which is keeping quite a few players away from the market. I wouldn't fear too much on a next 5% even downside from current levels. In any case, if there is a top up, we would advise investors to stay fully invested.
Manish, good morning. Neeraj here. So the volatility and the reasons that you referred to has led to a fair degree of corrective moves. But I was seeing the list of the top 15 losers on the BSE 500. Say all of them have come off because of very idiosyncratic reasons, results or RBI moves, etc., so on and so forth. Do the regulatory changes, for example, on the NBFC side, worry you about investing in that space as actively as you were maybe, or are you constructive on that pocket?
So two spaces where there has been a lot of fear. One is the PSU basket as a whole. Of course, they have made humongous money for investors, but just look at the numbers that have been coming out of PSU banks in general, even public sector entities as a whole. I mean, those numbers are just too good for the valuation that they are trading at. I would reckon that there's a whole lot of upside on the PSU basket, the PSU banks as a whole. But yes, there has been a lot of selling on the higher side whenever they seem to move up. But I would believe it's clearly misplaced, so to speak. As far as the NBFC space is concerned, that this is going to impact infrastructure funding, power sector funding, etc. I mean, listening to a few of these power financiers calls, I mean, they believe that it is India's accounting, wouldn't impact the P&L, the profit and loss account at all. It's going to be taken away from the reserves. It's going to, at best, impact tier 1 capital of 2 to 3%. But in any case, they are sitting on a tier 1 capital of 23%. This is just a draft paper, so to speak. Whether it's going to impact the entire funding from the PSU banking side as a whole, I would believe that the apprehension is misplaced. In fact, this was to get implemented, is only going to strengthen the risk management systems in the system. So, the size of the balance sheet of some of these NBFCs are going to be double at least between now and next 5 years. And of course, infrastructure, capital goods cycle, if one believes that this is going to puncture the capital goods cycle and the infra cycle in India, again, I would believe it's quite misplaced. So these are apprehensions. First of all, there is a draft paper applicable till 15th of June. Then there's going to be discussion on this. And then, how we heard the SBI chairman talk about yesterday that they are going to represent the PSU banking space concerns with the RBI on the draft implementation. So it's not a given. And in any case, if it gets implemented or gets diluted in its implementation, I don't think it distorts the bigger picture of infrastructure creation and capital goods cycle coming back in a big way.
So actually, I was going to ask you a separate question, but my follow-up to my question is this, Manish. Power financiers, it's a small bucket, 3 names maybe, largely, which are dedicated here. The con calls seem to suggest some extremely strong targets on the book size, on the profitability as well. And I think there was one Economic Daily which was saying that the government may even revisit these draft guidelines too. My question is, they've run up quite a bit already, so the low-hanging juice is out of the way. Are they still good investment candidates, the power financiers?
100%. I mean, What valuations are we talking about? If we think that these financials are expensive, we are talking about single-digit P multiples of 15%, at least a growth on the balance sheet, and a NIM, which is the best in class, north of 3%. And if you talk about the balance sheet and the leverage, the tier one capital stands at 23%. So the size of the balance sheet of the runway for growth is immense from where we are. So, we're talking about both of these financials, the bigger ones, combined balance sheet size in excess of 20 lakh crores in the next 5 to 6 years. And REC today maybe have a loan book size of something like just about 5 lakh crores. So, and Power Finance in any case is a holding company of REC. So, all of them put together, I mean, the size is minuscule, the runway for growth is good. I mean, they can grow very aggressively, but I would believe if they have to grow judiciously, then they should be growing at 15% and, doubling the loan book in years, which is pretty decent. And the valuations are very attractive from the point of view of, compare it with the private sector names. And even so on the dividend yield side. So I believe they are clear buys as far as the valuation and the fundamentals are concerned.
Manish, hi, morning. Tamanna here, and I was listening to your initial comments on poll jitters and the number of seats expected, etc. I just want to understand why voter turnout is such an important factor for market participants. How does it matter? How, beyond a point, how does it matter if instead of 400 seats, there are 300 or 320 seats? I'm just trying to understand the thought process, because you're going to have another phase on Monday. There might be another set of lower voter turnout numbers coming in. And will we then see a similar reaction?
Yeah, I mean, so if there's a continuity, then, people tend to take it lightly, plus the heat that is there across the country. Last time around in 2019, elections were in the month April, which was not that hot when you compare it with the current times. The elections are being held, let's say, the whole of May, and all parts of the country are pretty hot, so to speak. So that could be one of the reasons for the low turnout. And I think if there is a high turnout, which means that voters are enthusiastic for some sort of a change. But if there's continuity, it's just that they don't want to go and vote. Things are fine and good. I mean, that could work against the current NDA government, is what the belief is. I'm not a great expert on politics, but believe that strongholds of the ruling NDA government, where there is a low voter turnout, could be a case of concern.
So, that's the thing about election season. Everyone becomes an expert on politics at this time. But nevertheless, the market makes its decision based on what it perceives. I'm wondering, Manish, that would you gear up for more volatility till, say, the 3rd of June, when your exit poll numbers would be out? And, what would be your call in that case? Stay on the sidelines till the dust clears?
Not at all. I mean, I would take advantage of the volatility to deploy as much as I can. In any case, if there is any top up or new subscription, it gets deployed the first day. Because I clearly believe that, the policy direction in the creation of the new government, apart from, let's say, the budget jitters on the taxation front, and the roadmap is pretty clear as far as the earnings trajectory is concerned, the policy continuity. And I would bet on that side, the probability of the current government not coming to power is slim, even though the probability is there. And really, I don't side with the guys who believe that, yes, there has been such a great run-up in the markets that in any case, whoever comes to power, there's going to be a big fall in the market, and give it a few percentage points. But again, once the markets have fallen, you have no other choice but to buy, because India is one of the highest growth countries in the world, and you can't seem to ignore India. There's a lot of cash waiting on the sidelines. In any case, SIP money is pretty decent, and on top of that, if you have FI money come through, it's going to be a problem when it comes to quality stocks to buy. So if today it's available in plenty, I mean, best to lap it up.